Next, breakup of cost of project and means of finance should be given in the loan proposal so that sanctioning authority can understand that what are the components that makes up this project and how this project is being funded alongside of the proposed term loans. Let's see. Breakup of cost of every items. This makes the cost of project. Okay, it is not necessary that all these items should come in all the projects. No, if there is land, I mean if the project involves purchase of land, then that cost. If it involves constructing building or buying building, okay, acquiring building, that cost should come. Purchase of plant and machinery, and this should be ideally divided into indigenous and imported, okay, or say domestic. I'll make it as domestic and imported so that sanctioning authority can get a view of the forex risk involved here. Then what is the interest during construction period? Because interest during construction period can be capitalized by generally accepted accounting practices, and that can also be loaded as part of cost of the project. Then what is the working capital margin required here? Let's say when you take up this project, okay, let's say this is your new project, and if you start this project, you will start making sales, okay, but for making that sales, you have to purchase raw material, okay, you have to invest on labor, you have to invest on other cost. Only if you invest on all this, you will be able to achieve the sales. But for all this, you need capital, okay, you need capital. We call that as working capital, okay, but of this working capital requirement, the bank will be financing only around 75%. It means remaining 25% should come from the borrower. Fine. But borrower already he is asking loan for starting this project. He is asking loan for purchasing this land, building plant and machinery, interest during construction. Then he is actually not in a position to bring this 25% gap. So this 25% gap, that is working capital margin, can also be considered as part of cost of the project. Okay, if that project is going to result in additional working capital or creating new working capital requirement, then that working capital margin can also be loaded as part of cost of the project. Okay, and this practice vary from bank to bank. Public sector bank, they insist on adding this working capital margin under total cost of project because they appreciate that if this working capital margin is not given, he will not be able to get this 75% from the bank, and if that is not availed, then they cannot invest on these items. If they cannot invest on these items, they cannot make sales. If they cannot make sales, there is no profit. If there is no profit, then the term loan what they have given will become non-performing asset. Okay, so understanding this link, banks are very particular nowadays that working capital margin should be loaded as part of cost of project, and that should be funded. Okay, next, preliminary and pre-operative expenses, that should also be included, and contingencies. So all this makes total cost. Okay, so this is the breakup, and there can be some additions or some deletions on case to case basis. Okay, so here we are capturing cost. Then we should also give the breakup of source of finance. Okay, because here we said this is the cost. How that cost is going to be made? Through financing, right? So this is the amount which is coming in. Let me give some imaginary numbers. Let's say 100 million is the cost. It means this entire 100 million have to be financed. Fine, it has been financed. But how this 100 million had come into picture, or how this 100 million is going to come into picture? It is going to come from, let's say, 1 2 3 4 sources. That is, it's going to come from term loan, let me say around 70 million. Okay, then share capital around 10 million, internal accruals, let's say 15 million, unsecured loan 5 million. So how it looks like? It looks like 70 million is the loan, and 30, okay, 10 20 30 million is from owners, but in three different forms. And here techno-economic viability team will have their opinion on this. They may say that they are not going to accept this, they are not going to accept this, because if this unsecured loan comes with a higher interest rate, okay, then even though it is coming from promoters, this is also creating an obligation, okay, and it will also have impact on what is known as DSCR, debt service coverage ratio. Or if this unsecured loan can be treated as quasi equity, then it is fine, then it is fine, okay. So how this project is going to be funded, what is the source of finance, what is the split up that should be given, and by looking at this, sanctioning authority will be able to frame the soundness of capital structure in addition to what is discussed in techno-economic viability report.